Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom.
Alright, welcome again to our study with me. Well, this is a study loud. We study loud. If you're currently studying for the CPA exam, we invite you to stick around. But if not, if you're looking for something where you can focus and soft music and things like that, this is not for you at this time, because it's a loud study session where I sit down and study the lessons that I need to learn. Alright, well, thank you very much for sticking around. We'll go ahead and start working right now.
No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence.
Alright, so time to work. Time to work. On April 1st, year 3, Ivy began operating a service proprietorship with an initial cash investment of $1,000. The proprietorship provided $3,200 of service in April and received full payment in May. The proprietorship incurred expenses of $1,500 in April, which were paid in June. During May, Ivy drew $500 against her capital account. What was the proprietorship's income for the 2 months ended May 31st, year 3, under the following methods of accounting? Cash basis, accrual basis. Okay, so for cash, the money has to come in. For accrual, you need to provide a service. So, what was the proprietorship's income for the 2 months ended May 31st, year 3? So what do we have? On April 1st, okay, year 3, Ivy began operating a service proprietorship with an initial cash investment of $1,000. The proprietorship provided $3,200 of services in April and received full payment in May. Okay. Give the service in April, receive the payment in May. The proprietorship incurred expenses of $1,500 in April. Incurred the expense, but have not paid the expense in April, which were paid in June. Okay. During May, Ivy drew $500 against her capital account. Okay, so what is the income? Under cash basis, the service was provided for $3,200 and the money was received. So that's good for cash, and it is also good for accrual basis because you provided the service, the money is earned, you receive the payment, the cash is received. The proprietorship incurred expenses of $1,500. So this is where the problem is. $1,500 in April. So that means we will do for cash basis. All right. Instead of doing this for the sake of the video, let me just go straight to the answer, and then I will think about it myself. Okay. All right, step one, ignore things that are not income. Initial investment, $1,000. Owner contribution, not revenue. Ivy withdrew $500 in May. Drawing, not an expense. These affect equity, not income. Find accrual basis income. Under accrual accounting, revenue is recorded when earned. Expenses are recorded when incurred. Okay. Revenue services provided in April, $3,200. Okay, even though cash was received in May, revenue was earned in April. Revenue, $3,200. Expenses incurred in April, $1,500. Even though paid in June, expense belongs to April. So expense $1,500. Accrual income is $3,200 minus $1,500. That's $1,700. Accrual basis $1,700. Step 3, find cash basis income. Under cash accounting, revenue when cash is received. All right, this is revenue. Expense when cash is paid. Revenue, cash received in May, $3,200. Okay, the revenue is $3,200. Expenses were paid in June. That's right. June is outside the period ended May 31st. So expense recognized 0. So cash basis income is $3,200. CPA exam tip. When you see owner investment, ignore. Owner withdrawals, drawing money, ignore it. Earned but not collected, accrual revenue. Incurred but not paid, accrual expense. Collected but not earned, cash revenue. Paid but not incurred, cash expense. Based on the fact shown in the image, the correct result is okay. That's good. All right. So we got to be sharp with this. No wasting time. Step 1, ignore things that are not income. Okay. Step 1, ignore things that are not income. Initial investment, you ignore that. This is owner contribution. Withdrawals, $500, you ignore this because this is not an expense. These affects equity, not income. So you go ahead, you find accrual basis income. Accrual basis income, revenue, service provided in April. You know how much it is, $3,200. And the expense, even though the expense was not paid in the period, but it was incurred. So this is a accrual expense. for cash basis, the income was the money was paid in the period, so you can record that as income received. But what about the expense? The expense was incurred, but the cash was not paid. So under cash basis, this is not recognized. So the result is $3,200 in total for cash. Okay. Okay. And that's correct. I lost the page. Special purpose framework. Okay. Young and Jamison's modified cost basis financial statements indicate cash paid for operating expenses of $150,000, end of year prepaid expenses of $15,000, and accrued liabilities of $25,000 at the beginning of the year. Young and Jamison had prepaid expenses of $10,000, while accrued liabilities were $5,000. If cash paid for operating expenses is converted into accrual basis operating expenses, what would be the amount of operating expenses? I want to go straight to the answer so that we don't waste time. All right, so let's see what we got. All right, so let's do this one using your cash to accrue shortcut. Given cash paid for operating expenses, $150,000, beginning prepaid expenses, $10,000, ending prepaid expenses, $15,000, beginning account accrued liabilities, $5,000, ending accrued liabilities, $25,000. Step 1, start with cash paid, $150,000. Step 2, adjust for prepaid expenses. Remember, prepaid goes up, subtract. Prepaid goes down, add. Prepaid went from $10,000 to $15,000. Increase $5,000. So prepaid goes up, subtract $5,000. $150,000 minus $5,000 is $145,000. Why? Because you paid $5,000 more cash than the expense you actually used. Adjust for accrued liabilities. Remember, accrued liability goes up, you add. Accrued liability goes down, you subtract. Accrued liability goes up, you add. Accrued liability goes down, you subtract. Accrued liability went from $5,000 to $25,000, increased $20,000. So $145,000 plus $20,000. Why? Because accrued liability went up from $5,000 to $25,000, so you add the $20,000. It's $165,000. Why? because you incurred $20,000 of expenses that have not yet been paid. Answer: 165,000. For memory trick. When converting cash expense to accrual expense, cash paid plus increase in accrued liability, or more completely, well, I can't see the whole thing, but that's fine. That's fine. So we understand. And let me read the question again. Young and Jamaison's modified cash basis financial statements indicate cash paid for operating expenses of $150,000. End of year prepaid expenses $15,000. Prepaid expenses. Okay, and accrued liability of $25,000. At the beginning of the year, Young and Jamaison had prepaid expense of $10,000, while accrued liabilities were $5,000. If cash paid for operating expenses is converted to accrual basis operating expenses, what would be the amount of operating expenses? So what we do is that we start with what we have. We start with the $150,000. Okay, so now we will make the adjustments. End of year prepaid expense $15,000. In accrued liabilities of $25,000. But prepaid expense, beginning of the year, Young Jamaison had prepaid expense of $10,000. So prepaid expense went up, all right, from $10,000 to $15,000. So when prepaid expense goes up, you subtract. Prepaid expense goes up, you subtract $5,000 from $150,000. While accrued liabilities were $5,000. So accrued liability went up from $5,000 to $25,000. So what do we say? If accrued liability goes up, we add. When accrued liability goes up, we add. So we add the $20,000. So that's why we have $165,000. That's how we need to read these questions and understand them right away. Okay. So Zetacode reported credit sales revenue of $4,600,000 in its income statement for the year ended December 31st, year 2. Additional information is as follows. Accounts receivable, December 31st, year 1, $1 million. December 31st, year 2, $1.3 million. Allowance for credit losses, $60,000. December 31st, year 1, December 31st, year 2, $110,000. Zeta wrote off uncollectible accounts totaling $20,000. Totaling $20,000 during year 2. Under the cash basis of accounting, Zeta would have reported year 2 sales of what? So we got to do this fast, have the mentality of FAR. All right, so we start with what we have, which is the $4,600,000. We focus on accounts receivable. Accounts receivable increased from 1 million to 1.3 million. So there is a change of $300,000. So what we're gonna do, accounts receivable, when accounts receivable goes up, we subtract. Okay, accounts receivable, when accounts receivable goes up, we subtract. So subtract $300,000 from the $4,600,000. So here we have $4,300,000. We also account for the uncollectible accounts totaling $20,000. Zeta wrote off uncollectible accounts totaling $20,000. So we account for that minus $20,000. So 400 300,000 minus 20,000, that's $280,000. 2,280,000. No, I'm saying 4,000,000. $4,280,000. $4,280,000. I want to go in the exam and be able to do just that. As soon as I see the question, I already understand what's going on, and then I don't even need a calculator. I can just do it 1, 2, 3. That's good. Okay. All right, that's good. Okay. All right, a company records items on the cash basis throughout the year and converts to an accrual basis for year end reporting. Its cash basis net income for the year is $70,000. The company has gathered the following comparative balance sheet information. We have beginning of year, we have end of year. Accounts payable, $3,000, beginning of year, end of year, $1,000. Unearned revenue, beginning of year, $300, end of year, $500. Wages payable, beginning of year, $300, end of year, $400. Prepaid rent, $1,200, end of year, $1,500. Accounts receivable, $1,400, end of year, $600. Okay. What amount would or should the company report as the accrual basis net income for the current year? Net income. So we got to focus on cash. And is it accrual? What amount should the company report as its accrual basis net income for the current year? Okay, so we started with $70,000, and then we will go ahead and make the adjustment based on the information we received. All right, so let's go here. The far way, we start with the cash basis net income, which is $70,000. Now convert it to accrual net income. Okay, revenue adjustment. Accounts receivable beginning $1,400, ending $600. Accounts receivable decreased by $800. When accounts receivable decrease, it means you collected cash from prior year sales. That cash increase, cash basis income does not belong to this year. So subtract, right? Accounts receivable decrease, you subtract. Let me see if this is the same idea. Accounts receivable. Okay, accounts receivable decrease, you subtract. All right, 70,000 minus 800. Unearned revenue, beginning 300, and then 500. So unearned revenue increased by $200. You collected $200 cash this year for work not yet performed. Cash basis counted it as revenue. Accrual basis does not. So minus $200. Total revenue adjustment, 800 minus 200 is minus 800 minus 200 minus 1000. Expense adjustments. Accounts payable beginning $3,000, ending $1,000. Accounts payable decreased by $2,000. You paid $2,000 off last year's bill this year. Cash basis counted those payments as expense. Accrual basis does not. Therefore, plus $2,000. Wages payable beginning $300, ending $400, increased by $100. You incurred $100 more wages than you paid. Accrual expense are higher, therefore minus $100. Prepaid rent beginning $1,200, ending $1,500, increased by $300. You paid $300 more rent than you used. Cash basis expensed it. Accrual basis keeps it as an asset. Therefore, add $300. Combine everything. Okay. Revenue adjustments minus $1,000. Expense adjustments, 2,000 minus 100 plus 300, that's 2,200. Net adjustment minus 1,000 plus 2,200 is 1,200. Accrued income, 70,000 plus 1,200, $71,200. Okay. Instead of learning it by saying if account receivable goes up, subtract. If account payable goes down, add. I want to understand the idea instead, because you can easily forget accounts receivable goes up, you have to add. I need to know why. What's the idea behind this? For example, when we say you collected $200 cash this year for work not yet performed, cash basis counted it as revenue. Accrual basis does not. So subtract $200. I want to understand it just like this, but not when accounts receivable goes up you add with, because this you can easily forget that. Okay. Cash basis versus accrual basis. Ask one question. Did cash basis count too much or too little income? Then fix it. Okay? Accounts receivable. Accounts receivable means I earned the revenue, but I have not collected the cash. Accounts receivable increases. Suppose revenue earned is $1,000. Cash collected is $700. The extra $300 is sitting in accounts receivable. Cash basis only sees $700. Accrual basis is $1,000. Cash basis counted too little revenue, so you must add $300 exactly. Okay? Accounts receivable decreases. Suppose last year someone owed you $300. This year they finally paid. Cash basis accounts the $300 as revenue this year. But accrual basis says, no, that revenue belonged to last year. Cash basis counted too much revenue, so you subtract $300. That's right. Unearned revenue. Unearned revenue means I got the cash, but I have not earned it. I have not earned it yet. Unearned revenue increases. Customer gives you $500 today for work you will do next year. Cash basis says, great, that's money. Accrual basis says, not yet, you have not earned it. Cash basis counted too much revenue, so subtract. Unearned revenue decreases. Now you perform the work. Accrual basis recognizes revenue. Cash basis recognizes nothing because cash came last year. Cash basis counted too little revenue, so add. Accounts payable. Accounts payable means I incurred the expense, but I have not paid it yet. Accounts payable increases. Suppose expense incurred $1,000, cash paid $700. The remaining $300 goes into accounts payable. Cash basis only sees $700 expense. Accrual basis sees $1,000 expense. Cash basis counted too little expense. To increase expense, income must go down. So subtract $300 from income. Accounts payable decreases. Suppose you pay a $300 bill from last year. Cash basis records a $300 expense this year. Accrual basis says that expense belonged to last year. Cash basis counted too much expense. Too much expense means income is too low, so add $300 to income. Good morning, Audrey. Prepaid expenses. Prepaid expenses means I paid cash, but I have not used the benefit yet. Prepaid expenses, you pay $1,200 insurance today, covering next year. Cash basis says expense. Accrual basis says not yet, it's an asset. Cash basis counted too much expense. Too much expense means income is too low, so add. Prepaid decreases. You use up the insurance. Accrual basis records expense. Cash basis records nothing because cash was paid earlier. Cash basis counted too little expense. Income is too high, so subtract. The master CPA question for every adjustment asks, revenue item, did the cash basis count too much revenue or too little revenue? Too much revenue, subtract. Too little revenue, add it. Too much revenue, remove it because it's too much. Subtract it. Cash revenue, did cash basis count too much revenue? So subtract what the extra amount, subtract it. Too little, add it back because that's too little. Expense item, did cash basis count too much expense or too little expense? Too much expense? Well, add it. The expense is too much. Too little expense, subtract. Alright, so if you think through the story, you will almost never need to memorize whether accounts receivable went up or down. You'll be able to derive the answer every time, even if you forget the shortcut. I don't need the shortcut. I need to understand the story behind it. Give me a give me a 5 grader. Give me a 5 grader explanation of this version of this explanation. All right, let me fix lighting. Give me just a second. We're back. Okay. So let's get a 5 grader version of this. Perfect. Let's forget accounting for a second. Imagine you own a lemonade stand. The question is, as always, did I count too much or did I count too little? That's it. Accounts receivable, people owe you money. You sold lemonade for $10. The customer says, I'll pay you tomorrow. Today you earned $10. You got zero cash. Cash basis looks only at cash. It says, I see $0. Accrual basis looks at what you earned. It says you earned $10. Who counted too little? Cash basis, so we add $10. Now imagine the customer pays you next week. Cash basis says, wow, I got $10 revenue. Accrual basis says, nope, that sale happened last week. Who counted too much? Cash basis, so we subtract $10. Unearned revenue, someone paid you early. A customer gives you $10 today, but you won't make the lemonade until next week. Cash basis says, I got $10 revenue. Accrual basis says, not yet. You haven't earned it. Who counted too much? Cash basis counted too much, so we subtract $10. So this is in the case that we are changing from cash basis to accrual basis. Okay, we need to have that in mind too. Not in every case, because now we are changing from cash basis, converting from cash basis to accrual basis. So that's what we're doing now. So when cash counted too much, we subtract. When cash counted too little, we add. All right, cash basis, so we subtract. When cash counts too much, we subtract. When cash counts too little, we add. That's the idea. Next week, you make the lemonade. Cash basis says, no money came in today. Accrual basis says you earned $10 today. Who counted too little? Cash basis counted too little, so we add $10 for accrual. Okay? Accounts payable. You owe someone money. You buy lemons for $10. The store says, pay me later. Cash basis says, I didn't pay anything. Accrual basis says, you used the lemons. That's an expense. You counted too little expense. Cash basis, expense is too low. So income is too high. We subtract $10. Later, you pay the store. Cash basis says, I paid $10 expense. Accrual basis says, that expense belonged to last week. So it's always a conflict between cash basis and accrual basis. Who counted too much expense? Cash basis. Too much expense makes income too low. We add $10. Okay. Too much expense. So we add $10. So this is the idea. Prepaid expense, you paid early. You paid $12 for 1 year lemonade stand permit. Cash basis says expense $12. Accrual basis says, wait, you're going to use that permit all year. Who counted too much expense? Cash basis. Too much expense means income is too low. We add for accrual. Okay, so that's the idea. If you understand this, it will be much easier. The CPA secret, don't ask, did accounts receivable go up or go down? No, ask, did cash basis count too much or too little? If cash basis counted too much revenue, subtract. Too little revenue, add. Too much expense, add. Too little expense, subtract. That's the entire chapter idea. This is amazing. I love this. I love this. I love this. Okay. So going back to the question, we start with $70,000. We start with $70,000. We have accounts payable. That's money you need to pay. Beginning of the year is $3,000. End of the year is $1,000. Accounts payable goes down. Okay, accounts payable goes down. We have $2,000. So cash okay, I need to understand the idea. What? This is confusing. Okay. We start with the cash basis equals $70,000. Yes. We start cash basis net income $70,000. Now you convert it into accrual net income. Revenue adjustment, accounts receivable. Okay, accounts receivable, $1,400 going down to $600. So accounts receivable decreased by $800. When accounts receivable decreases, it means you collected cash from prior year sales. That cash increased cash basis income but does not belong to this year. Okay. Accounts receivable decrease $800. When accounts receivable decreases, is because you receive money that people owed you. Under cash basis, you report that money as money you received this year, but under accrual basis, that money has been accounted for last year. So you subtract it. Okay. Has been accounted for last year, so you subtract. Unearned revenue beginning $300, ending $500. So unearned revenue is when people pay you for service that you have not provided yet. So you have not earned the money, and there is an increase of $200 of unearned revenue that you have not earned. But under cash, you reported that money as money you earned. Under accrual, it says you have not earned that money. So we need to subtract that, because under cash you report too much. Yes, we subtract. Makes sense. Expense adjustment, accounts payable. Accounts payable is money that you need to pay, money you owe other people. So accounts payable, beginning of the year is $3,000, end of the year is $1,000. Accounts payable is going down. When accounts payable goes down, that means you pay money, right? So there is a difference of $2,000 here. You pay this year. You paid it this year. Under cash, you say, man, this is money I'm paying this year. But under accrual, it says that money has been accounted for last year. So you don't need to report that money. So we're going to subtract it. We're going to subtract $2,000. Wait. Accounts payable. Accounts payable from $3,000 to $1,000. Let me beginning to decrease by $2,000. You pay $2,000 of last year's bill this year. Cash basis counted those payments as expense. It is an expense for cash, but for accrual basis, it's not an expense. Okay, here we're talking about expense. We're not talking about receivables. It's different, okay? Expense. Okay, let's with expense mentality. Accounts payable is money I paid. I said I paid that. I just paid $2,000. I just paid $2,000 this year. Extra. This is expense. But accrual basis says that $2,000 was accounted for last year. Expense. So we need to add it back, because you cannot expense that money. That's gonna make your income goes low. So we need to add that $2,000 back. That's the idea for expenses. Wages payable. Wages payable from $300 to $400. Wages payable, that means end of year, there is a $100 increase in wages payable. So that means for cash, that $100 is not recorded for cash because you have not paid that money yet. But for accrual, that $100 is recorded. So cash reported too little, so we need to add that $100. Wow, it's subtract. Ooh, we need to subtract that $100. Okay. Wages payable. You incurred $100 more wages than you paid. Accrual expenses are higher. Therefore, subtract $100. It seems that I'm still mixing this up. I don't want to confuse you. I'm going to work on this on my own. I think we understand it so far, but I need to work on this on my own. Okay. Yes. Okay. I didn't think that would be so confusing. Let's get to work. All right, go to the next one. Redco reported cash paid for interest of $55,000 in its statement of cash flows for the current year. Red did not capitalize any interest during the current year. Decreases occurred in the following balance sheet accounts: accrued interest payable, $13,000; prepaid interest, $21,500. What amount should Red report as interest expense in the current year income statement? Okay. We're talking about expense, all right? Decrease incurred in the following balance sheet accounts. There is a decrease in accrued expense payable. There is a decrease in prepaid interest. Let's go straight to it so we don't waste time. Okay. All right, so let's use your new way of thinking. Did cash basis count too much expense or too little expense? Did cash basis count too much expense or too little expense? We start with cash paid for interest, $55,000. That's cash basis. Now we convert to accrued interest expense. Accrued interest payable decreased by $13,000. What does that mean? Imagine last year you owed the bank $13,000 of interest. This year you paid it. Cash basis says I paid $13,000 this year, so it's this year's expense. Accrued basis says nope, that expense belonged to last year. Who counted too much expense? Cash counted too much expense. Therefore, subtract. Okay. When cash counts too much expense, you subtract $13,000. Prepaid interest decreased by $21,500. What does that mean? Imagine last year you paid some interest in advance. This year you used up $21,500 of that prepaid interest. Cash basis says I did not pay anything cash for this year. Accrued basis says you used up $21,500 this year. That's an expense. Who counted too little expense? Cash basis. Therefore, add $21,500. Okay. Who counted too much? When you count too much, you subtract when you count too little in cash, you add. When you count too much, you subtract. When you count too little, you add. That's the whole idea. I need to understand. That's the whole idea. Okay. These inventory and accounts payable balances at December 31st, year 2 increased over their December 31st, year 1 balances. Should these increase be added to or deducted from cash payments to suppliers to arrive at year 2's cost of goods sold? Increase in inventory, increase in accounts payable. Okay, so let's understand that these inventory and accounts payable balances at December 31st, year 2 increased over their December 31st, year 1 balances. So there is an increase. There's an increase in inventory. There's an increase in accounts payable. Should this increase be added to or deducted from cash payments to suppliers? Cash payments to suppliers to arrive at year 2's cost of goods sold. Increase in inventory. Should you add this to payments to suppliers? To how much you pay suppliers? Increase in accounts payable. If accounts payable increase, that means that money you were supposed to pay, you have not paid yet. Is it under cash or under accrual? Okay, we don't want to waste time on this. It is so simple, it confuses me. My brain has got too complex with these other things. I complicate things when it's too simple. The fifth grader story method again. The question says, we start with cash payments to suppliers and want to get to cost of goods sold. Did we buy more stuff than we paid for? Or did we pay for more stuff than we used? Inventory increased. Imagine beginning inventory was 100 apples. You buy 50 apples. You sell only 20 apples. Ending inventory 130 apples. You still have a bunch of apples sitting on the shelf. What happened? You paid for 50 apples, but you only used 20 apples. Cash payments include apples you have not used yet. So cash payments are too high compared to cost of goods sold. Therefore, deduct the increase in inventory. Deduct the increase in inventory. Accounts payable increased. Imagine you bought 100 apples from a supplier, but you only paid for 70. You still owe $30. What happened? Cost of goods sold includes all the apples you bought and used, but cash payments only include what you actually paid. Cash payments are too low. Therefore, add the increase in accounts payable. the story. Inventory increased. I paid for some inventory that I have not used yet. Cash payments are too high. Subtract. Accounts payable increased. I used inventory that I have not paid for yet. Cash payments are too low. Add. Answer. Okay. Okay. Increase in inventory. The inventory increased. You pay for things you have not used. You pay for things that you have not used. I paid for some inventory that I haven't used yet. Cash payments are too high. So when you pay for things that you have not used, under cash payment, you record the expense. Under accrual method, you do not record that because you have not used it. You have not used that. So don't, under accrual, you do not report that. So that's why in this case, you will subtract. You will subtract because under cash, you're reporting too much. Increase in inventory, meaning that I paid for things that I have not used yet. So you need to deduct it from cost of goods sold. Increase in accounts payable. Increase in accounts payable. The idea is I used inventory that I have not paid for yet. No. Accounts payable increased. I used inventory that I haven't paid for. Yes, but you bought the thing. You have not paid for it. Under cash. What happened under cash? Under cash, you say, well, I didn't pay anything. But accrual says you incurred that expense. It is an expense. So under cash, you report too little because you say, I didn't pay anything. I just got the goods, but I didn't pay anything under cash because the money has not gotten out of your bank account yet. So under cash, you say, I didn't pay anything. So you report too little. Under accrual, it says that you have incurred this expense, so you need to report it. So in this case, converting from cash to accrual, you will add. Yes. That makes sense. I mean, it's just too simple. A complicated mind will complicate that, but it is a simple idea. That's for 5th graders. Things that you need to understand. Okay. What time is it? Okay, we have 7 minutes. All right. All right. So all right, so let's get to work. Susmenco prepared cash basis financial statements for the month ended January 31st. A summary of Susman's January activities follows. Credit sales of $5,600. Collections of $1,900 relating to January credit sales. Accrued salaries of $1,200. By what amount will Sussman's cash basis income for the month ended January 31st increase as a result of restating these activities to the accrual basis of accounting? To what amount will Sussman cash basis income for the month ended January increase as a result of restating these activities to the accrual basis of accounting? Okay, so from cash basis to accrual basis. All right, it's the same idea. Sussman Co. prepared cash basis financial statements for the month ended January 31st. A summary of Sussman's January activity follows. Credit sales of $5,600. These are things you sold, but you have not received the money. You sold the goods, but you have not received the money. That sells on credit. All right, so under cash, you say, man, I didn't sell anything today. Under accrual, you say, man, you got $5,600. You see, credit sales. Cash says, I didn't sell anything today, and you're sad. But accrual says, you sold things for $5,600, even if it's on credit. You have not received the cash, but you sold for $5,600. So this will be added for accrual because cash is not reporting it, but accrual will report it. Collections of $1,900 relating to January credit sales. Okay, so now you sold things in January and then you collect the money now. What month are we now? For the month ended January 31st. All right, so it's the same month. Collection of $1,900 relating to January credit sales. So you collected now $1,900. I believe that $1,900 is coming from the $5,600 of credit sales. Now, cash payment says, I collected $1,900. Accrual basis, well, is not reporting anything because it has already been reported and we are still in the same month. So this $5,600 still exists for accrual. Accrued salaries of $1,200. $1,200 accrued salaries. That means you have employees. Your employees are working. You have not paid them because the payday has not come yet. Under cash, you say, I have money in my account. Under accrual, you say, that money does not belong to you because this is payment they have to make. All right. So in this case, what you're going to do, accrued salaries, cash is reporting too little expense. When too little expense is reported, you need to add. Yes, you need to add. This is what I done. Okay, let's see. So we start with the credit sales, $5,600. $5,600. Accrued salaries, no. Well, salaries accrue even though you have not paid it. It's expense. So you need to subtract this. You need to subtract from credit sales. Yeah. It makes sense. I mean, don't overcomplicate things, my friend. Do not overcomplicate things. 5,600 minus 1,200. $4,400. What do we do with this collection? I wouldn't do anything with collection because it happens the same month. I won't do nothing with it. So let me see. I'll say $4,400. That's not right. It's $2,500. Okay. I mean, so we got to do something with the collection. It's the same month. What? So if I were to take the exam today, I would not pass these simple questions. Let's use too much, too little method. The question asks, by how much will income increase when we convert from cash basis to accrual basis? Step 1, credit sales, $5,600. This means we earn $5,600, but under cash basis, only cash collected is counted. So cash basis counted too little revenue. Oh, we gotta do something with the cash. They say by how much it would increase. They say by how much it would increase. Okay, minus the one. Okay, minus the $1,900. $2,500. That makes sense. Yeah, 2,000. Because here's what I understand here. Credit sales is $5,600. The question says by how much it would cash basis would increase. Okay, so by how much cash basis would increase? Let's finish this idea. Cash basis is accrual basis. By how much accrual basis will increase, right? So credit sales is $5,600. Collection in the same month, $1,900. Accrued salaries, $1,200. So what you're gonna do? You will say, okay, $5,600 minus $1,900 of cash collected under cash basis, and accrued salaries, salaries that are accrued, which is an expense. So you will minus the expense, and then that will give you the $2,500. Okay, let's go on break. We'll be back in 10 minutes, 9 minutes now.
Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you've got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come and study with me. Come and study with me. Come and study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too. Let it rise in you. Come and study with me.
I am late.
Come and study with me.
All right.
You've
Get back
got
to work.
what it takes. Oh, you've got what it takes.
Let's get back to work. Okay. Okay. All right, so we have this question here. On April 1st, year 3, Ivy began operating a service proprietorship. We saw that already, right? All right, on April 1st, year 3, Ivy began operating a service proprietorship with an initial cash investment of $1,000. Okay. The proprietorship provided $3,200 of service in April and received full payment in May. The proprietorship incurred expenses of $1,500 in April, which were paid in June. During May, Ivy drew $500 against her capital account. What was the proprietorship income for the 2 months ended May 31st, year 3, under the following methods of accounting? Cash and accrual, cash basis and accrual basis. So the question asks, what was the proprietorship's income? We need to know the income. What happened? Things that we need to ignore is the initial cash investment, $1,000. We need to ignore how much money they withdrew, the $500. We ignore that. So the proprietorship provided $3,200 of service in April, okay, and received full payment in May. April, May. The proprietorship incurred $1,500 in April, which were paid in June. During May, Ivy drew $500 against her capital account. What was the proprietorship income for the 2 months ended May 31st? So what happened in May? April and May. In April and May, they received the $3,200. The expense was incurred, but the expense was not paid. So let's go ahead. Let's go for accrual. For accrual, we have the money that was accrued and paid, but we have the expense that was accrued. So we're gonna do 3,200 minus 1,500. Okay, 3,200 minus 1,500, that's $1,700. That's for accrual. For cash basis, what happened for cash basis? For cash basis, April and May. April, the money was incurred, was received. The money was received in April, in May. So that means they received the money. What about the expense? The expense was only incurred, but it was not paid until June. So that means we only have, the only transaction we can report under cash is the $3,200. Under cash, $3,200 under cash, and $1,700 under accrual, which is correct. Okay. I did this one already. That's why I'm so sharp doing it. In its year 3 financial statements, Crisco reported interest expense of $85,000 in its income statement and cash paid for interest of $68,000 in its cash flow statement. There was no prepaid interest or interest capitalization either at the beginning of or end of year 3. Accrued interest at December 31st, year 2 was $15,000. What amount should Chris report as accrued interest payable in its December 31st, year 3 balance sheet? What amount should Chris report as accrued interest payable in December? All right, so we got to focus on interest payable. Crisco reported interest expense of $85,000. This is what we start with in its income statement, and cash paid for for interest of $68,000 in its cash flow statement, and cash paid for interest. All right. Accrued interest $85,000, cash paid for interest $68,000. So there is a decrease. Okay. So cash reports 68,000, accrued reports 85,000. There was no prepaid interest or interest capitalization either at the beginning or end of year 3. Accrued interest at December 31st, year 2 was $15,000. What amount? Okay, accrued interest was $15,000. Interest expense $85,000. And cash paid for interest is $68,000. And it's year 3 financial statement. Accrued interest December 31st, year 2 was $15,000. Payable December 31st, year 3. December 31st, year 2 was what amount should report accrued interest payable, and it's December 31st, year 3. Alright, I need to find out what's going on. Okay. Alright, so this is actually the same question you... Oh no, that's not the same one. Okay, let's do that. Okay. In these questions, you need to be able to do them under 2 minutes. What do we know? Interest expense accrued $85,000, cash paid for interest $68,000, beginning accrued interest payable $15,000, no prepaid interest. We want ending accrued interest payable. Tell the story. Interest expense is what the company owes for this year. Cash paid is what the company actually paid this year. Notice $85,000 is less than $68,000. The company incurred $85,000 of interest but only paid $68,000. So they didn't pay all of this year's interest. How much didn't they pay? $17,000. This year's unpaid interest is $17,000. Step 2. What about the old payable? Beginning accrual interest payable was $15,000. Think at the start of the year, they already owed $15,000 from last year. Part of the $68,000 cash payment was used to pay that old bill. Step 3, build the payable account. Beginning payable, $15,000. Add interest incurred this year, $85,000. Total owed, $100,000. Subtract cash paid, $68,000. Ending payable, $32,000. What? Okay. A 5th grade version of this. Imagine you owed your friend $15 from last year. This year, you borrowed another $85,000 or $85. During the year, you paid back $68,000. How much do you still owe? Okay. So let me go back and read it again to see. In its year 3 financial statements, Crisco reported interest expense of $85,000. Year 3. All right, this is in year 3. in its income statement, and cash paid for interest $68,000. Okay, so they pay $68,000. We would say from this $85,000. There was no prepaid interest, or interest capitalization, either at the beginning or end of year 3. Accrued interest at December 31st, year 2 was $15,000. They already owed $15,000 in year 2. They do it just to confuse you, the way they place the things. Why they didn't talk about the $15,000 before the $85,000? But no, they wait at the end. Accrued interest at December 31st, year 2 was $15,000. So total interest is $100,000. How much did you pay? $68,000. All right, so 68, 100 minus 68. That's why you have 32,000. What? See? 85 plus 15 plus 85 minus 68. That's 32. Man. We'll come back to it. Don't worry. We're going to master this. I'm going to be doing this in less than 2 minutes. You just look at it in less than 2 minutes, man. I'm going to be so sharp at this. All right, here's the question. The question says, the following information pertains to Speako's year 1 sales. Cash sales gross $40,000, returns in allowances $2,000. Credit sales gross $60,000. Discounts $3,000. On January 1st, year 1, customers owed SPE $20,000. On December 31st, year 1, customers owed SPE $15,000. So there is a decrease in accounts payable. No, in accounts receivable. Accounts owed SPE $20,000. December 31st, year 1, customers owed SPE. I say accounts. Customers owed SPE. On January 1st, year 1, customers owed SPE $20,000. On December 31st, year 1, customers owed SPE $15,000. So there is a decrease in accounts receivable. No accounts receivable were written off in year 1. Under the cash basis of accounting, what amount of revenue should SPE report for year 1? So here we're not talking about accrual, we're talking about cash basis. What happened? We have gross cash sales. All right, cash sales, $40,000. Returns in allowances, $2,000. Returns, $2,000. Okay. Accounts receivable. January 1st, year 1, customers owed SPE $20,000. December 31st, year 1, customers owed SPE $15,000. There is a decrease in accounts receivable. When there is a decrease in accounts receivable, that means you receive money from customers. You receive $5,000 from customers. Customers paid you $5,000. So you will add that money. You will add the $5,000 gross discounts. Add the $5,000 It would be 45,000. I don't know what to do with the returns and allowance. $2,000 returns and allowance. Okay, let's read that. Step 1. Fund the sales that were earned. Cash sales. Cash sales, gross cash sales, $40,000. Loss or less returns. There is a return. Net cash sales, $38,000. The return was $2,000. So 40,000 minus 2,000 is $38,000. Credit sales. Gross sales, $60,000. Less discounts, $3,000. So net credit sales is $57,000. Total accrued revenue, $38,000 plus $57,000, $95,000. This is revenue earned. But the question wants cash basis revenue, cash basis revenue, not accrued revenue. Step 2, tell the accounts receivable story. Beginning accounts receivable is $20,000. Ending accounts receivable is $15,000. Accounts receivable went down by $5,000. What does that mean? Customer paid $5,000. Customers paid $5,000 of old bills from last year. Cash basis says I got cash this year, so it's revenue. Accrual basis says no, that revenue belonged to last year. So cash basis revenue is $5,000 higher than accrual revenue. Calculate cash basis revenue. Start with accrual revenue, $95,000. Add collections of old receivables. That's $100,000. Really? How could it be? If you had gross credit sales, you have $60,000 credit sales. It's not cash. Credit sales, you have not received that money. I need to understand that. Cash revenue, $100,000. How could it be $100,000 if we have credit sales of $60,000, even though we have the discount? The discount is $3,000. That would make it $57,000 credit sales. So why would we account for this under cash basis? We are not counting the $57,000 credit sales under cash basis. Under cash basis, we only count cash received. The problem never says how much cash was collected from the $57,000 of year one credit sales. So how can we figure it out? Use the accounts receivable story. Beginning accounts receivable $20,000, ending accounts receivable $15,000. Net credit sales $57,000. Think of accounts receivable like an IOU bucket. Beginning bucket $20,000. Add new IOUs created this year plus $57,000. Total IOU that existed during the year $77,000. Ending bucket $15,000. That means customers must have paid $62,000. So actual cash collected from receivables was $62,000. Now calculate cash basis revenue. Cash sales received $38,000. Cash collected on receivables $62,000. That's $100,000. I see. Wow. Okay. I was going to ignore the credit sales altogether. But it says credit sales $60,000. Discount $3,000. Okay. On January 1st, year one, customers owed speed $20,000. Wait. On December 31st, year one, customers owed speed $15,000. That debt is from the credit sales. So if it says that January 1st, year one, customers, you make credit sales. I made some sales, but on credit. But they didn't say anything else. They say on January 1st, year one, customers owed me $20,000. That means from that $60,000, let's say from that $57,000, I collected. Let me see. How much? 40,000. Wait. 60,000. No, wait. 57,000 minus 20,000. That's $37,000. So I collected $37,000 from these people. From the credit sales. They say, okay, but at the end of the year, instead of owing me $20,000, they only owe me $15,000. So now I'm gonna say, okay, so instead of collecting $37,000, okay, instead of saying minus 20,000, I'm gonna say minus 15,000. So I collected $42,000 from that amount. But still, this is not giving me that 100,000. 42,000. Let me see the idea over there. Now calculate. Okay. Cash basis. Cash basis sells $38,000. Cash collected on receivables $62,000. I know. So actual cash collected from receivables was $62,000. Under cash basis, yeah, what amount of revenue should be reported for you? I still don't get it. Okay. Use accounts receivable story. Here's what I'm thinking about. Cash sales, $40,000 gross. There is return is of $2,000. So we have here $38,000 of cash sales. Gross sale, $60,000. We have a discount of $3,000, makes it $57,000. $57,000. So now, customers owed me $20,000. I'm thinking that if they say customers owed me $20,000, that $20,000 is coming from the $60,000 that I sold on credit. And at the end of the year, customers only owed me $15,000. I'm thinking that, okay, so now customers have paid me from that $20,000 they owed me. They paid me $5,000 that I'm going to add to the amount. So, okay, here is the first idea. So 20,000 minus 60,000, because they still owe me 20,000 from the $60,000. 20,000 minus 60,000, I have $40,000. But if I remove the discount, it will be $37,000. Now that they pay me $5,000 more, I would add that $5,000 on the $37,000 would make it $42,000. So I was gonna say, okay, so from credit sales, I collected $42,000, and from cash sales, I collected $38,000. That's what I was gonna say. Let me see what's wrong with this idea. Very close. The one thing that's tripping you up is the $20,000 beginning accounts receivable is not part of the $60,000 year one credit sales. Think of time. Beginning accounts receivable $20,000. This means on January 1st, year one, customers already owed me $20,000 from last year. Okay. That $20,000 is not from the $60,000. It's money they owed me from last year. Okay. Year zero, for example. That $20,000 existed before the $60,000 credit sales happened. So you cannot do 60,000 minus 20,000 because they are from different periods. Let's draw the accounts receivable bucket. Beginning accounts receivable is $20,000. Customers already owed me this money. Add this year's credit sales. $57,000 credit sales. Remember, the discount reduced the sales to $57,000. That's correct. Now, total receivables that existed during the year 20,000 is 20,000 plus 57,000. That's $77,000. Ending accounts receivable at December 31st, customers still owe you $15,000. So if $77,000 was owed during the year and only $15,000 remains unpaid, so $77,000 minus $15,000 is $62,000. I see. That's the amount collected from receivables. Why your $42,000 doesn't work? Your logic was they owed me $20,000 from the $60,000, but they did not. The $20,000 is from before this year's sales. Think of it like this. January 1st, old customers owe you $20,000. During the year, new customers buy on credit $57,000. Now total owed $77,000. December 31st, still owe me $15,000. Therefore, I collected $62,000. Wow, okay. Oof. The idea is that I was mistaken. Okay, cool. Now understand the $20,000 is before. Customers owed speed $20,000. On January 1st, year one, customers owed speed $20,000. Okay. So the following information pertains to speed year one sales. Year one sales. On January 1st, year one, so that means that debt is coming, that receivable is coming from previous year. But this year, see, this is, it is still more language than math. Because for the math, you can do the math. That's not hard math. But it's for you to understand. You understand the time, understand the trick they're throwing inside of this for you. It's really important for you to, yeah. But you will get it. It's more psychology than math. Psychology, language, that's all you need to be able to detect. Which of the following adjustments is necessary to convert cash receipts to revenue as reported on an accrual basis? Which of the following adjustments is necessary to convert cash receipts to revenues as reported on an accrual basis. Add beginning accounts receivable to cash receipts from customers. So understand the question. Which of the following adjustments is necessary to convert cash receipts? Money you receive as cash to revenues on accrual. So what is the difference? The difference is cash basis recognizes cash right now. Cash you receive right now. Accrual basis recognize money you earn right now by providing a service, even though you have not received the cash. So to convert cash basis into accrual basis, what do you have to do? Add beginning accounts receivable to cash receipts from customers. Subtract ending contracts liabilities from cash receipts from customers. Subtract ending accounts receivable from cash receipts from customers. Subtract ending accounts receivable. Yeah. Subtract beginning contract liabilities. I would say subtract ending accounts receivable from cash receipts from customers. Subtract ending accounts receivable ending accounts receivable $15,000. Cash receipts from customers. All right. We're gonna get it. Now we cannot be wasting time on this. Okay. This is a conceptual question. Let's use the story method. The question says cash receipts from customers convert to accrual revenue. Receipts from customers convert to accrual revenue. Then cash receipts include some things that are revenue and some things that are not revenue. Cash receipts include some things that are revenue and some things that are not revenue. Choice A, add beginning accounts receivable. Beginning accounts receivable means customers owe us money at the start of the year. When they pay us this year, cash receipts go up. But that revenue belonged to last year. So beginning inventory should actually be subtracted, not added. That's wrong. Subtract ending contract liabilities. Contract liability unearned revenue equals unearned revenue. Ending contract liability means we collected cash but have not earned it yet. Cash basis counted it. Accrual basis says not revenue yet. So we must subtract it. So subtract ending contract liability from cash receipts from customers. Subtract ending contract liability from cash receipts from customers. Subtract ending contract liability. Contract liability means unearned revenue. Unearned revenue. Service I provided, but I have not received the money yet. Subtract ending contract liability. Ending contract liability, we collected cash but have not earned it. We collected cash. No. Subtract ending contract liability. Contract liability is unearned revenue. Okay, you get the money, but you have not provided the service. You get the money, you have not provided the service. Cash says this is money, but accrual says you have not earned it yet. You need to subtract this. Subtract ending contract liability from cash receipts from customers. Yes. Contract liability. Remember, contract liability is unearned revenue. Is money you receive today for service you will provide next month. Cash says that I received money today, but accrual is saying that this money is not yours yet. This money is a liability. Therefore, do not report it. So subtract it. Subtract ending contract liability from cash receipts from customers. Okay. All right, you need to understand the language, my friend. But I did this when I was doing enroll agent, when I was doing the EA. But okay. What time is it? Okay. Alright, so this question says, I, Nicole, had the following beginning and ending balances in its prepaid expense and accrued liabilities accounts for the current year. For the current year, beginning balance $5,000, ending balance $10,000. This is prepaid expense. Accounts payable, beginning balance $8,000, ending balance $20,000. Debits to operating expenses totaled $100,000. What amount did Ina pay for operating expenses during the current year? Ina had the following beginning and ending balances in its prepaid expense and accrued liabilities account for the current year. Beginning balance, prepaid expense, beginning balance $5,000, ending balance $10,000. Prepaid expense increased. Prepaid expense increased. Accounts payable, that's money you need to pay to other people. Beginning balance $8,000, ending balance $20,000, increased by $12,000. Debits to operating expenses totaled $100,000. What amount did Ina pay for operating expenses during the current year? The question gives operating expense recorded. Debits to expense equals $100,000. Prepaid $5,000 to $10,000. Accounts payable $8,000 to $20,000. And ask how much cash was actually paid. Start with the expenses. With the expense of $100,000. Think we used up $100,000 of expenses, but did we pay exactly $100,000 cash? Not necessarily. Step 2, prepaid increased by $5,000. Prepaid increased by $5,000. Prepaid went from $5,000 to $10,000. What does that mean? Imagine you paid some bills in advance. You paid cash but have not used those services yet. So cash paid is more than expense. But you gotta think, I paid extra cash that didn't become expense yet. Therefore, 100,000 plus 5,000, 105,000. Prepaid expense increase, you add. Prepaid expense increase, you add 5,000. Accounts payable increased from 8,000 to 20,000, that's $12,000. What does that mean? Accounts payable. That money I have to pay, but that remains in my account. What does that mean? You incurred expenses but have not paid them yet. Think part of the $100,000 expense was not paid in cash. So cash paid is less than expense. Therefore, 105 minus 12,000. It's $93,000. Okay. I'm not gonna talk too much so that I can remember just that. Am I understanding that? Prepaid expense, beginning balance 5,000, ending balance 10,000. When prepaid expense increase, you add. When accounts payable increase, you subtract. So what's the idea behind that? Prepaid expense increase. What amount did Ina pay for operating expenses during the current year? Prepaid expense goes up. That's money you pay, $5,000 money you pay. You have not used the service yet. As an expense, this is an expense. Operating expense, I paid the money, but I have not used the service. This is under cash. Being balance in this prepaid expense, accrued liabilities account for the current year. I paid the money, but I have not used the service. This is an expense. but that should be under cash. I paid extra cash that didn't become expense yet. Therefore, I add. Expense and accrued liabilities accounts for the current is accrued. All right, I'm gonna leave it there. Let me keep going. All right. So I think I need to work on this on my own. Yeah. All right, I'm gonna end the live right now, and I'll keep working on this. Maybe I can come back and share my ideas. Is there anyone watching with me? All right. So thank you very much. If there is anyone in here, I'll see you again tomorrow.
Doom.